Good morning to all of you. So finally we are now here, not only the last day of the year, even last class of this subject of this semester. We have already covered various aspects of financial derivatives, but what I'll do now, I'll brief you what we have covered, and in addition to that, we will also discuss how you should attempt your exam. Articulation of attempting the examination will be common for all subjects, but what the scientific approach you have to have is specific to this subject, that also I'll discuss with you. First, understand this financial derivatives. When we started, we made it very clear that it is meant for hedging. A risk is there. By default, risk will appear. Risk may be external or internal in nature. Various approaches are there to manage the risk, starting from avoiding to transfer, sharing to diversification. But ultimately, one important aspect is there, how it is going to be hedged. Hedging is possible by reversing your position in some market, by doing something which is just opposite to your original position. Either you bring your position from uncertain to certain, or you reverse your position. That is the basics of your derivatives. When we say bring your position, its best example is forward booking. So something is which is there in future, and it is expected that in future some underlying influencing variable called factor will move adverse to your position. And if it is going to move adverse to your position, how you can hedge yourself against that adverse impact? And for that, it's better if you make a final contract today itself. What is that final contract today you are going to make is whatever it is there in future date, why not you should make it in present date itself. Present date position can get created. That's a simple exercise. That is what forward. From examination point of view, an important question from forward booking is expected from you to deal with. The second one is, which is again very important, it is forward had got one very important limitation, and that limitation was once you booked, at the time of booking itself, there had been a possibility that your position will be little loss making in the beginning itself. So it is not necessarily a complete hedge, rather a different price is given to you at that point of time when you are booking it, and that price becomes fixed. So it has got one merit, that price is fixed then and there, but it has got another demerit, biggest limitation, that the price which is coming to you in that present time may not necessarily be a favorable price. So you are compromising against a changing price versus a fixed price, which is little adverse ab initio from the beginning itself. That is there. So now a question arises, how to really cover that? Can it be possible If suppose someone is in a position to look for that, is it possible if suppose we want to make it in such a way that whatever present price is there, that price should be available to us. There should not be any kind of adversities, even if whatever the price movement takes place. And that is what we made that forward contract a very standard one, and that forward contract, a standard one, was actually futures contract. Futures was set. So when futures contract were made, then it has got its own benefit, merit. First merit was there that a perfect hedge could be possible with that futures contract. Second, the way you want, you can handle it. Any point of time you can trade it in the market, not necessarily you are going to hold it till last. It is an independent contract. Simply in your book, it could be considered to be a hedging instrument, as compared to that you have a original position. So comparing the two, your position is going to be a hedging position. Otherwise, anyone can take futures position without having any kind of underlying position, any kind of a spot position. One can take it. Good merits are there in the futures. Since it is exchange traded, so counterparty risk is also not there. But then there is another limitation. Rather, it's a biggest challenge in the futures itself, that it is not a price independent or path independent contract, the way forward was there. Forward contract, once booked, it is booked for that price, and what next the price is going to move is not going to affect you. But in futures market, even if you have made a contract at a particular price and price is changing on a regular basis, that regular change will also affect you. And that effect is because of a special positioning, a special activity called mark to market. Mark to market was there. Every time you are actually using it MTM. Second, the entire contract is highly magnified because of marginal position, margin trading. Marginal position means you are not actually exposed. You are not putting that quantum of money which is needed, a very smaller quantum of money, maybe 5% of the total requirement you are making it. But any kind of gain or loss is going to get calculated, it will be on the total amount. So that amount, if gain is there, that is also very impressive, very big amount of gain will be available to you on that smaller amount. But if loss is there, loss is also of that nature. Same is there. This is what it's a. So what is very important is here, how it is going to make it. So you have to calculate those margin trading. So actually in the question, what you require to use is three things. First, concept, futures and futures price, theoretical futures pricing, where we had seen that futures price may be bigger or smaller. If it is bigger, called contango. If it is a smaller, called backwardation. All those things were there. That's a one setup concept of futures were there, how it is different from forward and all other things. Second set was there, futures trading, how trading takes place, what kind of positioning is there, how impact is going to be there. And third important segment of the futures market was there, that you have to calculate margin. You have to look upon when margin call will be there. And we had already a span and others we had calculated. That is, so three different dimensions of futures were there. But one limitation, biggest limitation of futures was that if it is once booked, you have to have it. You can't escape it. Even if it has moved adverse, you have to square off your position. That loss you have to bear. So a choice has been, or an expectation has been, can it be possible a financial product which is, even if you are not interested, afterward you can give up. And that product came options. And in options, two parties, buyer and seller. Buyer called long position holder, seller called short position holders. Two products, right to buy, right to sell, right to buy called call and right to sell called put. These two products are there. Two different price. One is the price of options, another is the price of underlying. Price of option is called a strike price or exercise price, and price of underlying is called spot price. And then there is a price. So price of underlying is at which your option setting. There is a price of options also, called option price or option premium. So option premium is the price of option. A strike price is the price of underlying under options, and there is a comparison with the spot price, underlying price itself. And once it has been decided, you can go ahead with that options. Again, three important concepts in the options also, the way futures was there. First concept of options was, what is options? What are the various terminology related to options? Second concept was that options strategy. What are the various strategies of options? And third concept of the options pricing. Options pricing means it's how the pricing is going to take place. Two different methods we used in the pricings. One is called binomial, another is called Black-Scholes. Both are very important for examination. Numerical question will be there. Numerical will be there from your strategy. Numerical will be there from their pricing. It has to come. That entire exercise has been done. Options pricing, very, very important segment. It has been found either of the call or put price could be there, call premium or put premium, whenever we say pricing. Then after that, after completing this, we got another one important chapter, non-standard options, called exotic options. Various exotic options were there. See, exotic options is something like you have the options, but it is not standard. You prepare it as per your choice, bilaterally deciding, agreeing two parties together to make sure that what kind of features will be available to them, how they agreed upon. Depending upon all these things, they decided. So that's the way it is set. Now, once it has been done, there's options. We discussed another one important chapter called financial swaps, mostly OTC product. And in that OTC product, it is not a kind of exchange traded product, where long project financings and others used to be there. For financial swaps, most important product is interest rate swaps. How two parties coming together, agreeing together can reduce their overall borrowing cost, where three steps I mentioned. A step was there that any kind of position which is available, look into that without any kind of a swap arrangement, what kind of overall cost, total cost is going to be there, combined cost is going to be there to the parties. Then you reevaluate it if they exchange their positions, they swaps their positions, then what will be the overall cost. And once there is a gain out of it, is there is a benefit or not, that has to be cross checked. If suppose by exchanging there is no benefit, rather it could be worsening, means financial swaps are not possible. So the way they have to have should continue with their own position. But the moment there is a gain may be not necessarily arising originally to both the parties, may be originating to one party, because one party may have the relative advantage in both the positions. Still that gain can be distributed between two parties and financial swaps are possible. So for having financial swaps possible, it is essential that they should be combining their positions, they should be swapping their positions. It could be currency swaps, it could be commodity swaps, it could be credit default swaps, any of the product could be possible. That's the way it could be used. Now after that, once it has been made, very important aspect is whatever the approach we are going to make it, what was the essential component here? And you will find out essential component when we consider is every time some genuine position has been there and that position because of market movement, because of any kind of fluctuation in any macroeconomic variables, any underlying factor which is changing is making the position adverse or having some adverse realization. Maybe because of change in the price of underlying, maybe because of change in interest rate in the market, maybe because of change in exchange rate in the market, maybe because of whatever realization should be there, whatever gains should be there. You are expecting that customer will pay, customer has not paid to you, default position is there. You have to hedge yourself against that. So all those hedgings ultimately has to make it. The very essential component of risk is there, that there is a time gap and whatever position right now you have got may not necessarily be position afterward will maintain. This is not only in the field of finance, everywhere it happens, even in our regular life. The way I am today, I don't know what will happen with me after some time. I don't know. So how to really make sure that I am protected, I am covered. And every positions you have to have that covering. So time being we were discussing, that was an overall view of risk hedging, overall view of risk coverage, risk has to be managed. But now we are further penetrating deeper inside, one more deeper dive into the risk management and looking into that, rather diagnosing it effectively, making a dissections of the risk components and looking into that, what are the reasons of the risk. Is it because of a span of time? It is because of change of one variable or another variable. Because risk is there, deviation is there, we have to protect. But if you know that why risk is originating, what are the various sources of risk, and if we are able to identify the sources, then addressing those risk problems will be easier, will be more effective. And that is what we are going to have it. So instead of now talking and discussing the risk on a gross level, we are going to discuss at the micro level, factorial level, which factor is affecting and what will be the impact of it and how we can manage it. Especially who could be needing it. Any treasury operation is requiring these things. So those who are actually heavily involved into the financial market, in investment market, locking the fund for expected return, for them what we are going to discuss now is important. So any fund manager, portfolio manager, treasury operators, big project operators, all they require, those who have got a huge fund parked somewhere. Even not only that part, knowing this, you can be more aware where to park, how long to park, when to liquidate, when to exactly shift your product, your financial investment from one product to another product. All these questions which are very relevant when you are actually actively participating in the market, you require these things. This is what need is there. So, this is the background. Now, what happens at normal tradition is there. Risk has been thoroughly symbolized through Greeks. So, when we were talking about absolute measure of risk, irrespective of that, what are the source of generation, whatever the origin of the risk was not important, total risk was measured, it was measured through sigma, standard deviation. When we started measuring risk relative to each other, not in absolute term, rather in the relative terms, it was beta. Beta was measure of risk. When risk was known for a noviceness, very independent factor, it was called alpha. But now we are going to all these beta, alpha, or any of these factors if you consider, you will find out these are the Greeks, Greek letters. So, we will continue that practice and we will use those Greeks for other factors also, how it is going to get managed. Now, these factors are very important for all those who wish to join or work in financial market, investment environment. For them it is essential that you must look upon these things. Okay. Time being, you can consider it may be in the examination, it will be a small theory question because a good number of numerical has already been there, or a conceptual component could be set. But here we are going to use this. Understand one important thing. Look here, it's a delta then gamma, theta, vega, one more product you mention here called rho, RHO, rho. So, 5 total, rho I have not written, it's there in your book. Now, how to remember these things? At least these 5 Greeks, these Greeks are in addition to those 3 Greeks which you have already studied. What we have studied? Sigma, beta, alpha, right? In addition to that, these Greeks are there which are used to measure the risk. Now, how to really understand and remember what kind of relationship is lying among them, how they should be used by a fund manager, by investor, how it should be there. That is what we are going to have. As I was mentioning you that these risk measures are ultimately meant for addressing those specific cause of the risk. Say delta, if you look here, it says that measure the rate of change of options premium rate of change of options premium based on the directional movement of the underlying. Means how your option premium is changing because of change in underlying, that is called delta. So, delta is del premium change upon del underlying underlying price change, that is there. Second is gamma, rate of change of delta. It is rate of change of delta is there. So, what it mean? If we can say delta is first differential of premium price with underlying price, gamma is second differential of that, because it is change of change. That is what it is, change of delta itself. That's the way you can view. Third product is, say, theta, which is related to time span, measures the impact on premium based on time left for expiry. We all know whether it is premium or discount condition, as the time approaches, it merges, it converges, it reduces. More the time gap, bigger is going to be the loss. So, theta is actually measuring the change in the premium because of change in time. So, if suppose an option premium you have to calculate for underlying which has got 1 month maturity versus 2 month maturity, it is sure that 2 month maturity will have more premium. Of course, I am giving you the direct answer related to positive association. 2 months will be having more premium than 1 month. 1 month will have more premium than 10 days options, because as the time span increases, option premium increases. Next one is vega. It is what volatility is the one part, rate of change of the premium based on the change in volatility. Volatility changes. So, understand how volatility, what is volatility? There is a rapid movement in the market, but you don't know the direction of the movement. Very erratic movement is there, that is called volatile market. Market can go very up, market can come down very sharply, that is volatile market. If market is directional, then it is called rally or crash. But rally means it's upward movement, crash means down. But when you don't know, it's a very volatile market, then what kind of premium will be there? There is a way you can measure this volatility, premium can be viewed. So, it is there. One more item we have discussed, and that is what it was called. What was the term? Rho. Rho, change in option premium because of change in prevailing interest rate in the market. And interest rate is another one very important factor. What are the factors of interest rate? Interest rate take care of entire economic perspective. It take care of inflation. It take care of global international rate parity. Whatever the interest rate parity is there globally, that is taken care of. So, interest rate is a true reflection of economy, which is beyond the control of anyone. Other data can be manipulated, but prevailing interest rate is known. Yes or not? That is very clear. And you can try to control, you can try to attach, even if, say, for Indian economy itself, we had expected, or rather you can say, to give little more booster to the economy, a little bit of rate cut was expected. Inflation is to some extent under control. But what kind of a stand thou? Most of the economists, and theoretically it is correct also from my point of view also, that there has not been any kind of interest rate change. Stand was very clear. RBI monetary policy ultimately decided not to change rate of interest. That is whatever policy rates were there. That was met. So it is very important that how you are going to decide what kind of approach you are going to make. But one thing is also important, you can play with it. That's a matter of you can say discussion, difference in the approach, and slowly it is a behavioral approach also. Like if you ask me, a good number of time I start differing from what policy makers make it, what RBI governor thinks or monetary policy committee thinks. I say some little aggression is also important. Be aggressive. Time has gone where you have to be always thinking conservatively and always looking into very conservative approach. It's better you concentrate and work upon, go with full aggression. That is what my own perception, but that's my perception. Has limited scope to discuss among the students at a max 1 or 2 dayas where some different audience is there, but never ever have got a locus standi. Okay, just for self-satisfaction. Yes, I think like that. But that's a true part. That is row. Row is also important. Now, what is important here is, if you minutely observe, we will start talking about this slide is the slide we will discuss at the end, where once we understand how the entire exercise is going to be used, this is what we are going to understand here. What I'll be making is step by step, one by one chapter movement, how it is going to work. Now, let's understand here. Delta, it was the change in the price, premium, that is called premium divided by underlying stock, spot price. So, delta is what? Del C upon del S. Del C upon del S, when we consider, it is what rate of change is there. That is what I was saying. And when you look into gamma, gamma is the second differential of it. So, what is delta? Delta is, delta of a stock option is the ratio of the change in the price of the stock options to the change in the price of underlying stock. Means it's not only a stock, it could be applicable to any of the underlying, and that's why what we call it change in the price of premium with respect to change in the price of underlying. Whatever the underlying price is changing, that will be there. It is the number of units of stocks we should hold for each option sorter in order to create a riskless portfolio. So, if a riskless portfolio has to be made, a portfolio where you don't have to have the risk, it is going to be set riskless portfolio. The construction of a riskless portfolio is referred as delta hedging or delta neutral portfolio. What is this delta neutral portfolio means? Any kind of change which is taking place, if change is adverse, how you can protect yourself, that has to be made, that has to be viewed. That is what required. So, how you are going to make it? That is what delta hedging. Formula, you know that there is a difference, there is a change in the price below the change in underlying price. US stands for upward movement, FU stands for intrinsic value when there is upward movement, FD stands for intrinsic value when there is a downward movement. Difference of the two is what change in the premium. Change in the premium is going to be there. So, where C is the delta C, when we talk about C is the call option and S is the stock price. It is set. So, when you calculate, ultimately what this delta neutral portfolio, or I'll tell you one very important point. If you look for opportunity and someone asks you in the derivatives question, and if you are, they always start with the basics one, and that basic starts will be there. Options, you know, options is really a very big one chapter. You have seen options itself a chapter, exotic options you saw a chapter, then you are looking into this Greeks also. Ultimately, if you minutely observe, it is an option chapter, because how option premium, how option price will behave because of changes in the underlying factor, changes in the underlying stocks or underlying assets, how that price change is going to affect, that is what viewed here as a option one. ये हर बार प्रॉब्लम कर रहा है repeatedly.
आप सर कंटिन्यू पढ़ाइए, मैं इस पे देख लेता हूँ सेटिंग एक बार.
Now, next very important point is what exactly it is there. If suppose how delta neutral or delta hedging, at least one Greeks you must remember, at least one, and it is just one concept, one paragraph you remember. And after, as I was trying to help you, trying to mention you that as you move ahead, you have already answered basic questions. The interviewer will take you to the height of Greeks, because ultimately they want to check you that to what extent you are aware of, and then say how you will create a delta neutral portfolio or delta hedge portfolio, how you are going to make it. Actually, that is not from the individual point of view, rather it is a fund manager point of view. Some position has already been created. How you are going to make yourself neutral? You are taking your position covered, means you have got a position in options market, and back to back you have to have a position in underlying market also. So suppose you are going to have a position, say in option market, let's say a lot where it is a 2000 of the shares are there. You took position in options market for 2000 shares. Price movement is going to take place. Say you have gone for writing a call option, you are short call, and you have to protect yourself because of the price movements. How you will protect yourself? By creating a underlying position. When you will create your underlying position, that creation of underlying position will be very simple. How you are going to create that underlying position? By holding that positions, by holding that underlying asset itself. So two ways are there. You are taking one position in options market, another positions in underlying market. So you are protected. If this side price moves, it is going to give you again. If it is not, this will protect you. So you have always a safety net available with you. That is what you are going to create. So suppose here the example has taken, suppose the slope. What is slope? Del C upon del S. Del C upon the change in the C. C is what? Premium. Okay. Premium is what on? What is the slope basically? Del Y upon del X. Exactly on the same pattern it has been taken. So you mention here, you will find out that a complete creation will help you, and any kind of price movement, any kind of price change is not going to affect any further if you know your delta position. If your delta, so from where you will get the delta? Your delta you will get it from the previous price details. The way we have been using beta. You know, beta has been a measure of risk. I am repeatedly using beta as one of your reference material because you have been exposed to beta number of times. Even in corporate finance, you know that when we were using capital asset pricing model to determine the cost of equity, so risk-free rate plus beta into risk premium, RM minus RF. Do you remember These formulas in corporate finance you had used. Exactly the same way it is going to be there. How it is going to get applied, please. So, suppose stock price is 100 and call option premium is 10. Let's an investor have short call for 2000 shares. To hedge the position, investors shall have to buy. Let's in this previous one you will find out 0.6 is there. Delta is 0.6. So you have to make the position. So 2000 is going to be your positions in the options market. So how much underlying should be there? 2000 multiplied by 0.6. That is 1200. Now the 1200 positions has to get created by having delta as 0.6. The gain or the loss on the stock position would then tends to offset the loss or gain on the options position. The two will be offsetting each other. For example, if the stock price goes up by rupees 1, producing a gain of 1200 on the shares purchased, because you have 1200 shares, 1 rupee price has gone up per share, so 1200 is the gain. The option price will tend to go up by 0.6 into 1, that is 60 paisa, producing a loss of 1200. Clear? So, at the money example we had taken, we take the movement in any side, because that is, and you know, some similarity is there. Similarity related to futures market also is there. Can you recall, can you let me know where the similarity in the futures market is applicable here? Similar kind of things we have studied in futures market also. Similar ratio concept we have studied in futures market. Let me know. Exam is in your corner now. Which one? Which concept in futures market is more or less identical here? Whatever we are discussing right now, this delta, the proportion. हेज रेशियो से कैलकुलेट होता था, दैट इज हेज रेशियो, रो इंटू सिग्मा एस अपॉन सिग्मा एफ, वहां स्पॉट अपॉन फ्यूचर्स था, याद आया? दैट इज व्हाट इज देयर. सो हाउ मच पोजीशन यू आर गोइंग टू हैव in your futures market vis-a-vis your position in your underlying, that was decided through the hedge ratio, and for making perfect hedging, hedge ratio was must. Exactly same thing we are talking about delta hedging, right? Same we are talking about delta hedging. How much movement is there? Is this 0.6, so it's ultimately 0.6 times. Had it been 0.8, 0.8 times. That's the way it should have got calculated. So that's the way you have to view it. So it says, if the stock price goes up by rupees 1, you will have a gain 1200, but you will have a loss of 60 paisa per unit, 0.6 into 1, making on 2000 stocks loss of 1200. Why 60 paisa per unit? What this loss is meant here? How to understand it? It is basically, you have underlying as well as you have options position. You are a short call. Short call means you have sold the call option. What will happen when 60 paisa price has gone up? Sorry, 1 rupee price has gone up. The position holder, a 1 rupee price where it has gone in the underlying market. Vis-a-vis 60 paisa price up has been there in the options market. Resultant, what will happen? You will have to have a loss of 60 paisa in this options market. 60 paisa loss means on 2000 you have loss of 60 paisa per unit, making it 1200 rupees loss. But you have underlying also. Sometimes there is a natural underlying. If you are a harvester, like a farmer, you are an exporter who is receiving foreign currency, you are a stockholder who has already got a stock which has to be ultimately disposed of. So all those conditions are actually natural covered conditions. Their delta hedging could also be naturally possible. So, you can create that. Now, suppose if the stock price goes down by rupees 1, then what will happen? You will have a loss of 1200 on your underlying stock. Price has fallen down, but then in that case there will be a option price is also down by 0.60 and you will have a gain there, producing a gain of 1200 on the options written. Okay, so that's what the delta hedging is going to get created. Now, in this case, it is minus 1200. So, you will find out ultimately this means that the trader loses 1200 delta S on the option position when the stock price increases by delta S. The delta of one share of the stock is 1, then it will be exactly equal, whatever it is going to be. The delta of the trader's overall position is therefore 0. What will happen? That is delta neutral. What it is going to be 0? What the position is there? If exactly you are in a position to make your delta hedging, means neither you will have a gain nor you will have a loss whatsoever market condition, whatever the price moves, let it to move. जहाँ प्राइस जाता है जाने दो, कोई फर्क नहीं पड़ेगा आपको, आपका पोजीशन नेट 0 रहेगा. That is delta neutral. And since the delta of an option does not remain constant, that's another wondering of delta, that's a very big challenge. Doesn't remain constant, the trader's position remain delta hedged or delta neutral for only a relatively shorter period of time. The hedge has to be adjusted periodically, called rebalancing of delta. Why rebalancing is required? Because as the time passes, delta changes. And when delta will change, certainly the position will become, whatever perfectly hedged position was there will become partially hedged, will get exposure. So, you require to rebalance your position afterward. That rebalancing is needed. And doing it on a continuous basis, and you look into these kind of complexities, that leads to your use of some programming, some software which will keep on doing this exercise on a regular basis for you. And if you continuously keep on adjusting, means your position is not static, your position is not fixed, your position is dynamic. Dynamic hedging could be there. मतलब अभी जो आप हेज कर रहे हो उस हेज से काम नहीं चलेगा, फिर आपको हेज करना पड़ेगा, फिर आपको बैलेंस करना पड़ेगा. So, frequency and the volume of balancing is required. So, it becomes an active fund management. Okay? Active fund management is there. Now, this is what another important point. We all know D1, we all know ND1. Okay? How D1 to ND1 table, looking into table, that 4-digit, that making interpolation, all these we have learnt in the previous sessions when we were talking about Black-Scholes model. Recall that in Black-Scholes model, D1 and ND1 was required to be calculated. So, for a European long call option on a non-dividend paying stock, non-dividend deliberately has been made so that any kind of additional gain in the form of dividend interest or any other gain is going to make some adjustment or require some adjustment in your option pricing, okay, when you yourself has got a benefit. So, how it is going to get applied, that's very important. So, it says that for a European call option on a non-dividend paying stock, call is equal to, that is delta is equal to, delta of call is equal to ND1. So, delta is ND1. For a short position, delta call is equal to minus ND1. So, ND1 minus ND1, that is there. And we all know what is ND1, ND2. ND1 is the cumulative distribution function for standard normal distribution. Using delta hedging for a short position in a European call option involves maintaining a long position of ND1 for each option sold. Similarly, using delta hedging for a long position in a European call option involves maintaining a short position of ND1 shares for each options purchased. So, it is basically delta hedging for a short position in a European call option, for which for short position involves maintaining a long position for each option sold. Whatever option you have sold, you have a long position underlying. Reverse position has to be there. Sales position in your options and this long position here. Reverse way, using delta hedging for a long position in European call options, you have to have a short position in underlying. आपका position always inverse होगा, different होगा, then only you can manage it. So, it is that reverse position is going to get created. For a European put option on a non-dividend paying stocks, against it's not only ND1, rather ND1 minus 1. That is what delta is negative, which means that a long position in a put option should be hedged with a long position in the underlying stock, and the short position in a put option should be hedged with a short position in the underlying stock. So, understand here, delta is negative in the case of put option. It means long position should have with the long position underlying, short position should have with the short position underlying. So, positive environment call में था, जहाँ की डेल्टा आपका पॉजिटिव रन कर रहा था, वहाँ रिवर्स पोजीशन क्रिएट करना था. डेल्टा पुट नेगेटिव हो गया क्योंकि ND1 का वैल्यू ऑलवेज 1 से कम होगा. जब 1 से कम होगा उसमें आप कोई वैल्यू कम होगा, 1 माइनस करोगे तो वैल्यू माइनस हो जाएगा, और माइनस हो जाएगा तो आपको सिमिलर पोजीशन रख के आप उसको बैलेंस करोगे, क्योंकि माइनस तो पहले ही हो रखा है. इज इट क्लियर? दैट इज व्हाट डेल्टा ऑफ कॉल वर्सेस डेल्टा ऑफ पुट इज देयर. This is the two positions you look into. Only thing is that here it is what we talk about call. So आप देखिए 0 से ऊपर है, पॉजिटिव है, वहाँ पर देखोगे आप पुट है, डेल्टा है, वो 0 से नेगेटिव है, नीचे है, नेगेटिव पोजीशन है. That's the way call and put has been used. Now, typical patterns for variation of delta with time to maturity for a call options. अब time to maturity, as we know how, as I was trying to make it, whenever there is a midpoint, and that is called at the money. At the money is the position where options is neither, you are actually having no benefit, no loss situation. At the money is where it is at the point of time when you are viewing, it is at par with the what prevailing market price is there. So, whenever at the money is there, you look here. When you talk about in the money, there is a benefit associated to it, and benefit means it is going to be gain with options. You will, suppose you have a call options and you are a long call position holder, say at price X, and market price underlying a spot price has gone beyond X, then it is in the money. Okay? And in the money you will have the benefit. Out the money, a reverse position is going to be there. When your underlying price is lower than your strike price and you have a long call, then it's better not to exercise and let the options to expire. That is because it is out the money. But look very minutely the kind of gap which is here, either this side or that side, and gap there is, you will find out ultimately it merges to that positions. Position merging will be taking place. Okay. Now, there has been one small calculation also. We all know how to calculate ND1. So, calculation will help you to understand how you can use the delta also to be there. Delta of call, which is ND1 itself, delta of put, which is ND1 minus 1. How it is going to get applicable? Consider the call options on a non-dividend paying stock where the stock price is 49. The strike price is 50. So, a stock price is 49, a strike price is 50. it is a condition of out the money in the beginning. It is out the money because if it is a long call is there, we will not exercise this option. The risk-free rate is 5%. Time to maturity is 20 weeks, which of course requires to get converted into years. 20 upon 365 you will make it will get 20 weeks is there, 20 upon 52 you will get that value, and the volatility is 20%. So you will find out how the value is applicable. So D1 is you calculate log to the base e natural log s upon x plus r plus half sigma square into t upon sigma root t, and that value is 0.0542 D1, which ND1 will be 0.522. When the stock price changes by delta S, the option price changes by 0.522 delta S. That's the way price valuation. ND1 is actually delta. It is delta. Any question you have? Because I have tried to explain you how delta has been working. Then after this I'll show you one small example which I tried to calculate delta using some market figures and taking into how the value should be decided. Any question here? 20 weeks कितना year है? 20 weeks means 20 weeks. 52 weeks are there in a year. 20 by 52 करो ना फिर. हम क्यों 20 weeks को मंथ में ले जाएं, जब ईयर में ले जाना है तो रास्ता सीधा जा सकता है, तो है ना. और कोई क्वेश्चन? आज हम लोग डेल्टा पे हैं, राइट? So look into this calculation also. I'll be simply reading for you, making you better understand how this can be applied. On a particular day, call option on Nifty was as follows: 10,000, just a second. 10,292.65 at 9:18 in the morning. Option premium was 144, whereas the strike price was 10,250 for Nifty. At 10, Nifty went up 10,315.50. Premium went to 149.40. At 10:55, Nifty came down to 10,288.95. Premium came down to 133.50. As market fluctuates, so is premium fluctuating at a given strike price. It is there. Okay. Now, if you look here, suppose it says you have to calculate at 3:15 p.m. on the same day. It is expected that Nifty will be 10,355. 10,355. Right now at 10:55, how much it is? 10,288.95. What will be the option premium at that point of time? Simple question. Using delta, one can find out. So it means if you can predict the underlying price movement, then in that case easily you can predict the premium also. Subject to that, delta is known to you. Okay, if delta is known to you, you can predict that, and that is what it has been used. So how it is going to be there? So delta of an option helps us answering this question of this sort. क्या कह रहा है? By how many points will the option premium change for every 1 point change in the underlying? The delta measures how an option value changes with respect to change in the underlying. This is what the statement. So it captures the effect of the directional movement of the market on the options premium. अब देखो आप यहाँ पे ऐसा कर सकते हैं कि 2-3 टेक्निक है, and it's not necessarily whatever the answer here it has been shown, it has been calculated, the same will be applicable. It is not necessary that what we can make it are different way to look upon, and these differences are going to create a lot of difference among the different players. जैसे इसमें क्या है कि अगर आपको डेल्टा निकालना है तो डेल्टा कैसे निकालोगे? आपको चेंज इन प्राइस 918 10,292 था और 10,315 हो गया. You can make a delta S which is denominator, and you have change in the option premium which is numerator. That change divided by this change is going to be your delta. Similarly, the second case you are going to make it delta. 2 will be a different value. Now question is which value you are going to take. So how much is the value there? 149.40 minus 144. What is the value? 149.40 minus 144. 5.40 is the numerator. And similarly, just take 10,315.50 minus 10,292.65. How much is the value? Quickly. How much? 22.85. So you make that 5.4 divided by 22.85.
0.2363.
So exactly on the same way, you take that another one also. How another one you will make it? The next price change between two. 10,288.95 minus 10,315.50. How much is the value? Negative 26.55 is going to be your denominator, and 133.50 minus 149.40. How much? So minus 15, minus cancel out 15 point, that you make it. How much is the value? 0.59. Now question is here. This is the point I want to highlight. Now which delta we should consider? Are you getting me? It is within 1 hour or 2 hours of time. Within 2 hours of time, we have to decide delta is changing dramatically. And not necessarily these many things will be there. In between also so many prices could be possible. This is just the two of the observations we have considered at two different point of time, at 9:18 and 10 and 10:55. So two changes, two deltas are available. Which delta we should apply? And here is that subjectivity comes into picture. That is what I want to say. You have to decide. One is 0.26,
One is 0.236,
0.236 or 0.24,
0.236, next one is 0.598,
0.598 means 0.6.
means 0.6,
Yes, and 0.24.
0.4.
And now it's a very huge difference between two delta in a short span of time. And not only that, if we increase the number of observations, So what is now here, your mathematical aptitude is going to get applied. Sir, take the weighted average or take the average of a big. If we take average of these two, it will come somewhere 0.42. Right? That's the way it is going to get applied. Question arises here, how we are going to apply. And if suppose we say, why not we use previous day, lot of changes previous day, every 1 hour moment, whatever price has been there, delta of the previous day we will apply to next day. So this is what I wanted to say. These are the way through which you can mature yourself that which delta is going to be good for you, how you are going to be better predictor, and that is what applicable. So look here, and this is the delta is a number which varies between 0 and 1 for call. Some traders prefer 0 to 100, between -1 to 0 for put. Put I have already mentioned it is negative, it is always on the downside, and we have already seen if it is for call option delta it is be a reverse position. For long it should be short, for short it should be long, whereas in the put option it is similar position, long for long, short for short. That you have to create. So let's, what the solution we have tried to make it. We got delta of the option say 0.55 assumed. Okay, 0.55 we have assumed. From where it has come? And of course you know only two different point of observations, two different options delta has come to you. So when I say 0.55 you can't challenge me. I have n number of observations available with me and it could be possible 0.55 is there, right? So that's why it is written assumed. And Nifty is going to be 10,355. So when 0.55 is there and we know change in the underlying price. So what is the price here? You look minutely, you will find out what was the previous price. Previous price is 10,288.95. And here what is the price? 10,355. How much is the difference? कितना difference हो रहा है? 10,355 minus 10,288.95. 66.05 multiplied by 0.55. 36.3275. That is what you said delta call, delta change in the price. And what is that? It is increasing, price is increasing positive. So add that with 133.50. So your next price expected is 169. Is it clear? You got the new option premium from a different route using delta. Right? You can keep on making one to another. To be for your kind information, delta is heavily used by fund managers. आप कहीं भी किसी भी अच्छे फंड मैनेजर की बात करेंगे, इमीडिएटली वो डेल्टा की बात शुरू करेंगे. डेल्टा हेजिंग, डेल्टा न्यूट्रल पोर्टफोलियो, सब बहुत कॉमन सा वर्ड है. ओके, और इस तरीके से आप यूज़ कर सकते हैं. सो नाउ ड्रॉप इज ऑल्सो अगेन टेकन इन दैट वे. नेगेटिव हो जाएगा. अगर ड्रॉप है प्राइस का तो नेगेटिव होगा. एंड यू कैन calculate. I am just crossing over. Selection based between two options. Yes, that's a very important point. How you are going to decide it. So our question is, which of the two options? So many options products are there. When I was showing you direct live from the market, I think I had shared with you, taking you to money control. And when I was showing you direct to market, at that point of time I had shown you different strike price were there. Different options products are available. Question arises, which one is good for you? So it says we expect a 100-point up move on Nifty, and based on these expectations, we decided to buy an option. There are two call options and we need to decide which one to buy. Call option 1 has a delta of 0.05. whereas call option 2 has delta of 0.2. तो कौन सा आप लेंगे? सीधी सी बात है, जिसका डेल्टा बड़ा होगा उसको ले लेंगे. Is it clear? So what it says, because 0.05 means movement 0.05 times only. 2 means movement bigger time. What we are making is a bigger movement capture we are going to try. So better benefit, more benefit should be there, and that should be applicable. Now the same 100 move points will give you more benefit for second one call options. So that call option 2 is going to get applicable. Come to next. Again, delta of a portfolio is nothing but it is weighted average delta of all. आप देखोगे यहाँ पे डेल्टा ऑफ पोर्टफोलियो क्या हो रहा है? डेल्टा ऑफ पोर्टफोलियो इज WI अपॉन डेल्टा I. आपके सारे स्क्रिप्ट का आपको डेल्टा निकालना पड़ेगा और उसके बाद उसका वेट जैसे जैसे वेट है, जो प्रोपोर्शनेट प्रेजेंटेशन है, दैट actually you are going to have WI del I is what it is there. So the formula can be used to calculate the positions in underlying asset necessary to make the delta of the portfolio 0. Delta of portfolio 0 means ultimately whatever the price movement takes place, it will not change and delta will remain constant. When this position has been taken, the portfolio is referred to as being delta neutral. So what is delta neutral portfolio? Is that when delta of a portfolio is going to be 0. What is delta of a portfolio is going to be 0? The entire price movement in the portfolio is not going to affect the position of the portfolio holder. Portfolio holder will be indifferent from the any kind of price movement. That is what it is there. So it is, and how it is going to be there? 2 legs are there, 2 arms are there. One arm is actually taking position in what you say options market, and another is an underlying market. Okay. Example also there, a long position in one, short position in one, how you are going to make it, how position is going to change. So I suggest you, I'll share this PPT with you all and you can go through with that. That is what delta is. Delta, one important segment I had to discuss. So many dimensions are there, and as I mentioned you, terminology is important, and those terminology you are going to apply on a regular basis. Okay. Look here. Now come to theta. Theta is measure of what? Change in the timing. A better understanding is there. Delta is actually change rate of change of underlying price. Gamma is change of delta itself. How much change in delta is there? V for vega, change in volatility is there. Volatility, V for volatility, V for vega. T for time, T for theta. That's the way to remember. So theta is actually measuring it. Rho RHO, rho R से रो है तो R से रेट है. इंटरेस्ट रेट में चेंज होगा तो रो का हो जाएगा. So you can at least primarily you know, you can connect it, you can relate it, and you can remember it. Okay, that's the way you can view. So again, theta is what with the time span it is there. We all know again D1, D2, you remember actually when you were making D1 formula, ln S upon X plus R plus half sigma square into T. T was time was there on the numerator. Even in denominator there was a time, sigma root T. And I had emphasized and highlighted this. So if time increases, time is in numerator, time is in denominator, what will be the net impact? Because mathematically we understand, under mathematical modeling, if something is in numerator, any increase will increase the value. If it is in denominator, any increase, it decreases the value. If a factor is both numerator, denominator, what will be the net impact? So, in this case time is a factor which is in numerator also as well as in denominator. So, what will be the net impact? Answer is very clear. Had it been identical, net impact should have been challenging and negligible. But here it is clear cut. Magnified presentation is magnified presence is there in numerator and very diminished presence is there in denominator. In numerator it is t, time. In denominator it is root t. So, it is a square time present in the numerator. So, direct relationship is going to be bigger. So, time factor is going to be bigger impact, and that is what the relationship has to be established. You can easily through basic calculations it can be calculated. So, what it says? It says that the theta of a portfolio of option is the rate of change of the value of the portfolio with respect to passage of time, with all else remaining the same. It is always with the partial derivative concept where remaining factors has to be constant. Then you can really look into one factor's impact with our relationship with the change in the premium. Also referred as the time decay of the portfolio. It is also called as time decay of the portfolio. As the time decays, how the premium will be behaving. For a European call option on a non-dividend paying stock, it can be shown from the Black-Scholes model and that equation have already indicated. So, call and put both has to be there. You just go through with the formula related to time span, how time is going to work with. So, value is set. Now, here I like to highlight one more important point is in this formula as Black-Scholes formula is using it. So, the theta of a put exceeds the theta of a corresponding call by r k into e to the power minus r t. K e to the power minus r t is nothing but it is present value of k. E to the power minus r t is actually the discounting factor for that given time frame. So, basically it is r k present value of k, and k is the strike price, whatever the strike price is there. R is the risk free rate, okay, and that is what the value of theta is going to be there. So, risk free rate, how it is going to get applied. In these formulas, time is measures in years, time always in years, I have already mentioned. Usually when theta is quoted, time is measured in days, so that theta is changed, a portfolio value when 1 day passes with all else remaining the same. We can measure the theta either per calendar day or per trading day. To obtain the theta per calendar day, the formula for theta must be divided by 365 because ultimately calculation has to be for year. To obtain theta per trading day, it must be divided by 252. Why it is also it is there. Calendar days are actually 365, but trading days are only 252. Okay, because normally what happens, it's generally assumed that market works only for 5 days. When market works for 5 days, then in that case 52 weeks multiplied by 5 making it 260. There are on an average 6 to 7 holidays are there. So, sometime it is or 8 holidays are there. So, sometime it is 252 or 253 days of the working days of the market is there, and that is why it is 252 division is going to take place. You can go through with this theta calculations and you can look into how much is used. All these ultimately how time decay, as the time passes how the value is there, and at a particular point of time how it is variation of theta of European call option with the stock price, how a stock price move, k is also given at that point it is maximum value of the theta is coming, and after that as the time is reducing ultimately theta will also be reducing. This is typical pattern for variation of theta for European call option with time to maturity. So we have seen that if it is out of the money, lesser variation will be there. In the money, more variation will be there. At the money, bigger variation will be there. But ultimately, all at the time to maturity, it will merge. Gamma, simple two-liners I'll give you, not beyond that, and it is variation of delta. Okay, if we can make it, here it is power 2 has been taken, otherwise we can write that gamma is equal to del of delta divided by del s, and del is nothing but it is del C or P, call or put premium, del C upon del S. So you can say del S square, whatever pi is there, it is basically nothing but it is the premium, and S square is 2 times of the change in the price. Okay, that is what value is put. Now, what is important here to you is some relationship. Okay, how some relationship has to be used. Look here, if gamma is small, delta changes slowly, and adjustments to keep a portfolio delta neutral need to be made only relatively infrequently. And gamma is what it is, more change in the frequencies of delta is there. और अगर गामा स्लो, गामा लोअर है, गामा कम है, गामा स्मॉलर है, तो आपको डेल्टा बार बार एडजस्ट करने की जरूरत नहीं होगी. इफ गामा इज हाईली नेगेटिव और हाईली पॉजिटिव, डेल्टा इज वेरी सेंसिटिव टू द प्राइस ऑफ अंडरलाइंग एसेट्स. इट इज देन क्वाइट रिस्की टू लीव ए डेल्टा न्यूट्रल पोर्टफोलियो अनचेंज फॉर ए लेंथी टाइम. इसका मतलब क्या है, अगर बहुत हाई वैल्यू है, चाहे नेगेटिव वैल्यू हो या पॉजिटिव वैल्यू हो, either of the direction if it is there, you require to make adjustment, a frequent adjustment for your delta. When the stock price moves from S to S dash, delta hedging assumes that the option price moves from C to C dash, and when in fact it moves from C to C double dash, the difference between C dash and C double dash leads to a hedge error. The size of this error depends on the curvature of the relationship between the option price and stock price. Gamma measures this curvature. तो आप देखिए क्या कर रहा है कि can I have attention here? Continue talk. So how you are going to decide it very clearly. This very illustration itself is making you point clear. होना क्या चाहिए था कि S से S dash change हुआ price. We had just now calculated for Nifty कि Nifty अगर 10,288 है, उससे 10,355 हो गया, तो प्राइस चेंज हुआ, तो कितना प्रीमियम चेंज करेगा. हमने प्रीमियम निकाल दिया एक रिलेशनशिप निकाल के. लेकिन अब कह क्या रहा है यहाँ पे, यहाँ इसका कहना है कि ये जो चेंज है वो चेंज बड़ा हो गया. अब जैसे आप मान लीजिए हमने क्या प्रीमियम निकाला था, 133 से 169 प्रीमियम निकल गया था. अब यही निकला ना. अब अगर वो प्रीमियम मान लीजिए 169 ना होके जिस समय 10,355 हुआ, वो प्रीमियम 169 की जगह पे 175 हो गया. अरे गेटिंग मी? तो सारा तो आपका फेल कर गया ना. प्रीमियम तो 169 होना चाहिए था, कैलकुलेशन तो आपने वो किया, हो गया प्रीमियम कितना 175. अब ये जो एक्स्ट्रा 6 रुपीज है उसको कौन कंपनसेट करेगा, कहां से आएगा, व्हाट इज द फैक्टर, व्हाट इज द रीजन. वही वह कह रहा है कि अगर प्राइस एस से एस डैश होना था तो प्रीमियम सी से सी डैश होना था, लेकिन सी से सी डैश होने की जगह कहां चला गया, सी से सी डबल डैश चला गया. 175 हो गया 169 की जगह. तो ये जो डिफरेंस है सी डैश से सी डबल डैश, 169 से 5 का जो डिफरेंस हो रहा है 6 रुपीज़ का, दैट इज ड्यू टू गामा। यहीं पे गामा आपका काम कर रहा है। डेल्टा चेंज किया ना आपका, डेल्टा बदल रहा है, गामा क्या कह रहा है, डेल्टा को बदल रहा है, वो डेल्टा चेंज की बात कर रहा है। तो वही कह रहा है कि सी द लीड्स टू ए हेजिंग एरर। वो जो एरर है 6 रुपीज़ का हेजिंग एरर, द साइज ऑफ द एरर डिपेंड्स ऑन द कर्वेचर ऑफ द रिलेशनशिप बिटवीन द ऑप्शन प्राइस एंड द स्टॉक प्राइस। गामा मेजर्स दिस कर्वेचर, गामा उसको मेजर करता है। Suppose that delta S is the price change of an underlying asset during the small interval of time delta T, and delta pi is the corresponding price change in the portfolio, then this is what the theta is going to be having. And for a delta neutral portfolio, theta is the theta of the portfolio. This is theta. तो delta pi आपका रिलेशनशिप निकल रहा है, कैसे आपका पोर्टफोलियो का प्राइस चेंज करेगा, कितना आपका बदलेगा। देखिए ये सबसे बड़ा फैक्टर क्या होता है, ये स्मॉल चेंज में भी बड़ा चेंज आ जाता है। ये देखिए यहाँ पे एक न्यू कर्वेचर क्रिएट हुआ सी डैश से सी डबल डैश का। दैट कर्वेचर इज व्हाट मेजर्ड बाय द गामा। दिस इज व्हाट वैल्यू इज गोइंग टू सेट। सो आप इसको कवर कर सकते हैं, पढ़ सकते हैं। रिलेशनशिप आपको दिया हुआ, यस। नाउ हियर इट्स अ वेरी इंपॉर्टेंट पार्ट इज relationship between delta pi, delta S and delta T for the delta neutral portfolio: slightly positive gamma, large positive gamma, slightly negative gamma and large negative gamma। चारों तरीके से आपको दिया हुआ है। स्लाइटली पॉजिटिव, स्लाइटली नेगेटिव है, कोई बहुत फर्क नहीं पड़ेगा, आप डेल्टा को छोड़ भी सकते हैं। अब 169 से 169.7 हो गया, कोई बहुत फर्क नहीं पड़ने जा रहा है, लेकिन 169 से 175 हो जाएगा तो फर्क पड़ेगा। न्यूट्रलिटी में आपके डिफरेंस आएंगे, तो इस डिफरेंस को काउंट करेंगे। वेरिएशन ऑफ गामा विद स्टॉक प्राइस फॉर एन ऑप्शन। अब इससे ज़्यादा गामा की ज़रूरत नहीं है आपको, मैं इसको क्रॉस कर रहा हूँ, थोड़ा सा एक और लेके आ रहा हूँ, एंड देन वी विल, यस, रिलेशनशिप। दिस इज द वन slide I request you to little get adjusted with. These slides are available to your John C. Hell book. So go through with that details. You will find out here देखिए थीटा, गामा, delta. This relationship is important. Relationship between delta, theta and gamma. And simple meaning is here that if in any relationship, suppose you know theta and gamma, you can find out delta. You know delta and theta, you can find out gamma. You can easily, so with the help of two, third can easily be detected. Third can easily be found. यही तो मैथमेटिकल रिलेशनशिप में है कि अगर 3 टर्म के बीच में रिलेशन है और उसमें 2 टर्म का इन्फॉर्मेशन आपको है, तो तीसरा टर्म आपको रिलेशन से पता चल जाएगा कितना टर्म होने जा रहा है, क्या होने जा रहा है। तो इससे फ़ायदा क्या होगा आपको कि इफ़ यू आर एबल टू कैलकुलेट डेल्टा, सपोज आपने पूरा हिस्टोरिकल डेल्टा निकाल रखा है, डेल्टा इज अवेलेबल टू यू, यू हैव गॉट थीटा ऑल्सो, सो यू विल गेट गामा एज वेल। एंड जब गामा आपको मालूम है तो गामा के रिस्पेक्ट में आप डेल्टा को एडजस्ट करते चलो। डेल्टा न्यूट्रल फिट जो डायनेमिक एडजस्टमेंट डेल्टा का है आपको मिल जाएगा, डायनेमिक एडजस्टमेंट कर लोगे आप। सो दैट्स अ कैलकुलेशन विच इज रिक्वायर्ड। एज आई मेंशन, वेगा इज वॉलेटिलिटी, ज़रूरत नहीं है वेगा का आपको, वेगा फिर भी थोड़ा सा सिर्फ थ्योरी के पॉइंट ऑफ व्यू से पढ़ लीजिए। द वैल्यू ऑफ डेरिवेटिव is liable to change because of movements in volatility as well as because of change in the asset price and the passage of time. Vega of a portfolio of derivatives is the rate of change of the value of the portfolio with respect to the volatility of the underlying assets. Underlying asset के price में कितना है, तो volatility कैसे measure होता है, सिग्मा से। तो अब देखो यहाँ पे आपका क्या, वेगा इज एक्चुअली चेंज इन द पोर्टफोलियो। देखिए पाई जहाँ लिखा हुआ है इसका मतलब पोर्टफोलियो है, कीप इन माइंड। ये जो आपका है ये पोर्टफोलियो के प्रीमियम की बात हो रही है, और सिंगल सी या पी लिखा रहे तो एक पर्टिकुलर अंडरलाइंग स्टॉक की बात हो रही है। तो यहाँ मैं डेल्टा सी भी यूज़ कर सकता हूँ, डेल्टा सी यूज़ करके उसके अंडरलाइंग सिग्मा को काउंट कर सकता हूँ। दूसरा तरीका है पोर्टफोलियो डेल पाई को यूज़ करके आप निकाल सकते हो। सो दिस कैलकुलेशन अल्टीमेटली टॉक्स अबाउट डेल पाई अपॉन डेल सिग्मा। एंड सिग्मा कैसे निकलेगा? तो सिग्मा निकालने का टेक्निक आपको पहले से पता है कि आप उस पूरे एरिया का निकालेंगे, आप जो भी अंडरलाइंग ऑब्जर्वेशन है से एक्स, तो कई ऑब्जर्वेशन एक्स होंगे आपके। अगर हिस्टोरिकल है तो सबका आप फिर मीन निकाल लीजिए। मीन निकालने का टेक्निक है सम डिवाइडेड बाय एन, मीन आ जाएगा। फिर एक्स माइनस एक्स मीन का आप सीरीज निकालेंगे, उसका स्क्वायर करेंगे और उसका समेशन करेंगे, डिवाइडेड बाय एन करेंगे, आपके पास आ जाएगा। उसको अंडर रूट निकाल देंगे, स्टैंडर्ड डेविएशन आ जाएगा। क्लियर? स्टैंडर्ड डेविएशन निकालना। अगर फ्यूचरिस्टिक वैल्यू है, फोरकास्टेड वैल्यू है, तो प्रोबेबिलिटी होगी, पी से मल्टीप्लाई करके निकालेंगे। दैट्स द वे यू कैलकुलेट। सो दिस वैल्यू इज गोइंग टू बी देयर। इफ वेगा इज हाईली पॉजिटिव और हाईली नेगेटिव, if vega is highly positive or highly negative, the portfolio's value is very sensitive to a small change in volatility. बल्कि कई बार ऐसा होता है कि for small investors, retail investors, it is advised when high volatility is there, high vega is there, don't enter in the market. और वेगा मेजरमेंट आपके, आप एक इंडिकेटर देखोगे विक्स, इंडिया विक्स, इंडिया के लिए इंडिकेटर तो विक्स ही है, ठीक है। तो जो विक्स है ये और कुछ नहीं, ये इंडिकेट करता है। और जितने फंड मैनेजर्स हैं सब विक्स को देखते रहते हैं। मतलब वो कहते हैं ना, विक्स इज समथिंग लाइक करंट इन वाटर। तैरना है, नहीं करना है, पानी के अंदर जाना है, और पानी के अंदर अगर बहुत ज़्यादा फ्लडी होता है तब फिर आप मत जाओ। दिस इज नॉट अ काइंड ऑफ एडवाइजेबल सिचुएशन। कूल काम वाटर है, आराम से एंजॉय करो। करंट है वाटर में ज़्यादा, जैकेट ले लो, और अगर उससे हेवी करंट हो गया तो कुछ मतलब जाओ ही मत। दैट्स द ओनली रिस्क मेजर। ओके, एंड दैट हैज़ टू बी व्यूड अपॉन। यही है ना, हम लोग लाइफ सेविंग इसी तरह करते हैं। फ्लड में और उस तरह के उसमें नहीं कहते कि आई नो हाउ टू स्विम, आई एम ए ग्रेट, मैं ओलंपिक का चैंपियन हूँ। ये वहाँ ओलंपिक नहीं चलने वाला है। ओलंपिक का चैंपियन बंधे हुए पानी में काम किए हो आप, छोटे से पानी में। तो एग्जैक्टली सेम इज़ हैपनिंग। कई बार पोजीशन ब्लेंडर कर देते हैं वोलेटाइल मार्केट। वोलेटाइल मार्केट बहुत वेगा हाई कब होगा? जब कोई बहुत बड़ी न्यूज होगी, बहुत बड़ा मैक्रो इकोनॉमिक हैपनिंग्स होगा, तब मार्केट में पूरा का पूरा कह सकते हैं उथल पुथल मच जाता है। एंड दैट इज़ व्हाट मार्केट इज़ वेरी रिस्की। सो दैट्स द वे यू मेक इट। रो इज इंटरेस्ट रेट का है, इसमें दिया हुआ है ही नहीं, मैंने लिखा ही नहीं, भूल गया नहीं नोट करना। That's it from my side related to these Greeks. Whatever the Greeks calculation is there, I request you again, remind you the final capsulation of this chapter Greeks. These are the measure of risk. Delta I try to explain little in length, which is very, very important. Doesn't mean others are not important. But of course, among the Greeks, if anyone wants to understand from you, the first Greeks want to understand is your delta. अगर पहला कोई क्वेश्चन 99% आपका अगर कोई ग्रीक में कोई क्वेश्चन पूछेगा तो डेल्टा से पूछेगा। हाँ, आप डेल्टा दे देंगे जवाब, तब उसके बाद फिर रादर नेक्स्ट क्वेश्चन वेगा, गामा और थीटा की बात उठती है। लेकिन वो भी आप लोग थ्योरेटिकली थोड़ा सा कनेक्ट ध्यान रखिए। थीटा टाइम फ्रेम से है, गामा डेल्टा के चेंज की बात कर रहा है, वेगा वॉलेटिलिटी की बात है, स्टैंडर्ड डेविएशन के चेंज की बात कर रहा है, चेंज इन स्टैंडर्ड डेविएशन है। चेंज इन स्टैंडर्ड डेविएशन कैसे निकालते हैं? हम अलग अलग टाइम फ्रेम करते हैं, बहुत अच्छा मॉडल वगैरह। फॉर्चुनेटली आई हैड अपॉर्चुनिटी टू वर्क ऑन दिस ऑल्सो ऑन अ रियल डेटा। मैंने थोड़ा निकाल रखा है, कर रखा है, तो अच्छा लगता है कि यू कैन व्यू दैट कि हाउ मार्केट इज़ देयर तो कहते हैं ना कि एक आप थियोरेटिकल पढ़ रहे हो, दूसरा प्रैक्टिकली आप उसको देख रहे हो मार्केट में। तो सबसे ज़्यादा अभी तक इंडिया में जो 2009 की वॉलेटिलिटी थी, वो अभी तक उस तरह की फिर वॉलेटिलिटी नहीं आई है। बीच बीच में उधेर बुन हुआ है, थोड़ा बहुत उठापटक हुआ है, खास करके जब मैक्रो इकोनॉमिक हेवी डोज स्ट्रक्चरल रिफॉर्म्स, स्ट्रक्चरल चेंज आए हैं, जैसे सपोज कीजिए जीएसटी इंट्रोड्यूस हो गया, डिमोनेटाइजेशन हो गया, लेकिन उसके बावजूद भी एक्चुअली हुआ क्या है कि इंडियन मार्केट हैज़ गॉट ए गुड स्ट्रेंथ, very good strength, and Indian market is right now, and the way Indian market is moving, it is marvelous. I don't know, we hadn't expected. I was really just few weeks back I was talking to Bombay Stock Exchange classes, BSS classes were there again forum this. I had simply said that you keep on monitoring, and are we expecting that whether it is by end of the year or by 1st February, the budget day, stock will go to, Sensex will go to 70,000 or not. At that time it was hovering around 67,000 or this. So 70,000 will achieve by this year end or by 1st February or by 31st March. These are the dates which are premium dates, landmarks. Okay. Here it is, now we are talking whether we will see 75,000 by that time in Sensex or not. So what it means actually, movement is very high. Second question is there that whatever earlier, around 10-15 years back, we used to talk about certain effects. One of the very important effect was called December effect or January effect. Under December effect, market used to come down. Why used to come down? Because foreign investors used to liquidate their positions, used to go for Christmas vacations, their Christmas is little longer. So they used to liquidate your position. So liquidating position means booking the profit, acquiring of your position, sell pressure get created and market is down. But interestingly, in this December period, itself market has moved like anything. Right? And you look into the market movement, it is something around 7% gain is in December only. So suppose someone had got taken enter in the market on 1st December and liquidated on 31st December or say 29th December, 7% plus gain has been there, which is 1 year gain in bank, just in 1 month. Sensex, a very cool product compared to one stock. And that gain has been there. And that which month? December month, where foreigner used to take their money out. Means Indian market is now truly Indian in nature. Not a kind of a proxy name India driven by Americans and Europeans. It's not anymore. It is actually Indian market. That's the way Indian market is moving. Inherent strength is there. Intrinsic value is increasing. Now a second question is there any fear market will crash? Answer is no visibility. Nowhere it is actually visible. No factor is visible. Some surprise element comes out, that's a different matter. But no factor is visible which will pull it down. Still it is there. And if things will get, the way momentum is moving and the way political forecasting is coming up, by March 75,000 will be achieved. It will easily be there. Because already it is 72,000 plus is, for good number of days it has already been closed. We just concentrate closing price. We don't look intraday high or low. We look into closing price, we look into that volume of the market. How much volume is there on that price? And if volume is sufficiently available on that price, means the potential to go up is there. And if that is going to up, you can now calculate. We have seen Nifty calculation here. So if you have that view, you can easily calculate with. So this is all about from my side. And thanks. It's last class of the semester, last class of the year. Okay. And I wish you all the best for your exam. Happy New Year and good luck for your final exam also. Thank you. Thanks a lot. बंद कर दो, कह दो क्लोज करें. Ask them to close. Move fast. Okay. Any question you have? Anything? Because from my side, you go through with the details, read it.
मेरा सर वॉलेट उधर में एक ये इसको अब क्लिक कर, इस पर क्लिक कर. हाँ अभी लाइव आ रहा है. हैंड स्प्रिंग होगा ना. हाँ अभी एक बार आने तो दे, तभी तो हैंड स्प्रिंग करेगा. अभी चल ही रहा है ना. अब